So, hi guys, it's SJ speaking, and in today's video, we're going to see about one of the most important topics in technical analysis, that is the market structure. In fact, it's the most important concept in technical analysis. That's why it is called as the king of technical analysis. So, market structure is known as the king of technical analysis. So, before going into the topic, let's see what is technical analysis. So, technical analysis is just the chart analysis, full and full charts. So the technical analysis does not consider the company's fundamentals. He doesn't care about it because he knows that the company's fundamentals, whatever the news, everything is reflected in the stock market's price. So only price and volume is seen in technical analysis. So market structure is one of the concepts in technical analysis. So let's see about it. So the first thing is when coming to the market structure. So what is its definition? So before going into that, technical analysis has two kinds of analysis. Some traders use price action, some use indicators, some use both. But mostly, I use indicators for references. I also suggest you do the same. Indicators are used for reference purposes only. There are two kinds of indicators such as leading and lagging. Leading indicators predict the market, whereas lagging indicators only shows you the direction of the trend. What the actual trend? It shows the what's the already what is there. It shows you. So it doesn't show predict or shows anything new. It shows what there is already is. That is why it is known as trend following indicator. So apart from it, others follow price action. And the market structure is a representation of price action. That is why the definition is given as. So market structure is a representation of price action. Shows you the trend, direction, and current flow of the market by highlighting swing highs and swing lows. So it shows you the direction of the price movement like this, or in the case of this is a bull market, this is a bear market. Bull market means uptrend and bear market means downtrend. So or a sideways market. So this is what market structure shows, and the swing highs and swing lows. So swing high, swing low, swing high, swing low, swing high, swing low, swing high, swing low, swing high, swing low. So this is what is swing highs and swing lows. So basically, there are three types of trend in the market. The first thing is bullish trend, that is the uptrend, and second thing is bearish trend, downtrend, and third thing is sideways trend. It is also known as bunny market or a sideways market or range bound market. There are several names, but usually it is known as sideways market or range bound market. So why the bull market got its name? It's because usually the bull attacks anyone by using its horns, and it pushes them upward using its horns. So that's why the market is known as the stock price moves up and up, it is known as bull market. Whereas in a bear, what it usually does, it uses its claws to pull its enemy or other animals down, and it pushes down. So as the market falls and falls, it is known as a bear market. So that is why this is the name. That's how the name comes. So the third thing is sideways market is also known as bunny market. So sometimes it is known as range bound market. So these are the things. So first trend is bullish trend. So what is a bullish trend? A bullish trend is defined by a series of higher highs and higher lows. The trend continues in the same direction until the asset price records a lower low. So this is the structure of the bullish market. This is the uptrend. So this is the uptrend. So stock prices move up and up and up. So suppose take a stock price. This is the starting point, and the first up movement where it forms an initial structure high, then it comes down, it forms a higher low, that is here, sorry, higher low, and then it again moves up, forms a new high. So it forms a new high. It breaks out the previous initial structure high and it forms a new high, and it then again comes down, forms a higher low, but it doesn't go down the previous higher low. It doesn't go down like this. It should stop here, somewhere here, around here, but it should not go around below the previous higher low. So then it again goes up and it again breaks out the high and forms a new high, and it again comes down, and if it breaks up again and forms a new high, then the trend continues. This is what the bullish trend is. So this is what the structure is. So usually starting point, initial structure high, higher low, higher high, higher low, higher high, higher low. So the trend reversal occurs The trend continues until the asset price records a lower low. Why I bought the asset price? It includes this works not only in stock market, it also works in currencies, commodities, and any other asset class. So the trend follows in the same direction until the asset price records a lower low. How a lower low is recorded? See, once the market goes here and breaks the higher low, there is a potential for the trend to reverse, but the trend is not confirmed as a reversal. Then it again goes up and then it comes down, and if it breaks down the new low which is formed, then forms a lower low. This is where the trend gets reversed. The trend reversal gets confirmed. Here is the warning sign after it breaks the higher low, and here after it breaks the new low formed, it is known as the lower low. So you can take it as this is normally a higher high, but once it breaks, you have to take it as a starting point, and this is as a initial structure low. I will come to it in the later thing. I will come laterly. So this is enough for this slide. So this is okay. So bearish trend. A bearish trend is defined by a series of lower lows and lower highs. The trend continues in the same direction until the asset price records a higher high. So this is the starting point. Then the initial structure low is formed. Then lower high, lower low, lower high, lower low, lower high, lower low. This is also lower low. But since this is the first point where the starting point is formed, I named it as initial structure low. You also consider it as an initial structure low. For short form, you can consider this ISL. So this is it. Here the market breaks down the first initial low and it forms a new low, and then it forms a lower high, and it again breaks down and forms a newer low. As it forms a newer low again and again, the trend is in continuation bearish trend. The trend is continuous. Once the trend breaks the lower high, then there is a potential for the trend to reverse from bearish to bullish. Then it again comes down, then it again breaks down the newer high formed, then that is considered as a higher high. Then you should take it as a higher low, then it is a initial sorry, you should take it as a starting point, and this is as a initial structure high, and this as a higher low. I will come to it in the next slide. This is just for an example. This is where the trend will get reversed. So next thing is sideways market. A sideways trend is defined by a series of equal highs and equal lows. The trend continues within the same range until the asset price records a new higher high or lower low. So a sideways market has equal highs and equal lows. So you can take it as a resistance and support point. So this is known as support, and you can take it as a resistance. So you can take it as a resistance. So this is the support and resistance point. So starting point is here. It forms a high, it forms a low, it forms a high which is equal to the previous high. It forms a low which is equal to the previous low. Then high again equal, low, low, low. So this is how the trend continues in a sideways market where the stock doesn't move upside or downside. So how the trend gets break? It gets break like this, or it gets break like this. So this is how they occurs. So you should take it once the trend breaks. I will come to it in the later slides. I will come to it in the later slides. So now it's enough for this slide. So this is how basically is. So market structure, what is market structure? The three trends: bullish, bearish, sideways, bullish, bearish, sideways. Bullish means uptrend, bearish means downtrend, sideways means side trends. So the complete trend of the market. So this is what occurs. You might see that this is like a sideways market, and this is like a sideways. This is bullish and this is bearish. Definitely, there are two sideways market and one bullish and bearish market. So what is accumulation? When a stock price is first introduced or a trend first just occurs, so who does the accumulation first? There are two types of traders. We are the retail traders, and other traders and the other big players are known as institutional traders. The bigger banks or the hedge funds or the mutual funds, the bigger those who invest lump sum amount of investments, they are the bigger players who are known as the institutional traders, whereas we are small traders, retail traders. So the retail traders, what's the concept of the share market is usually you should buy at low and sell at high. But what the retail traders does, They usually buy when only when the market goes upside for a specific number of moments, and usually they sell when it only comes down a specific number of times. Specific After some down movements only the retail traders will sell, and after some up movements only the retail traders will buy. So usually retail traders buy at the middle or buy at the high point, and usually sell at the middle or sell at the lower point. But the institutional traders, these are the value investors, the bigger investors. These they are good at analyzing the stocks and the company itself. So they know what the company delivers, what the company, how the company will be profitable in the future. So what they buy at the lowest point, or if they sell at the highest point. This is what they do. So what they do, they create the demand for the stock first. They buy here. When no one is buying, they buy the stock at the lower prices, and they create the demand for that stock. Once they create the demand at a specific point, the stock breaks out. So this is where the demand, the higher demand, this is where the retail traders come to know about the market, and this is where the news will come about the stock price, that the company has the company is taking more profits, like fundamentals. It comes news comes like that, and the retail traders get interest, and they start bidding the prices higher. So the people who bought here, the institutional traders, they take it as an advantage, and they used to sell their stock at higher prices. And the traders such as us, the retail investors, will be interested in the stock so much that we are willing to pay higher for that stock. So the institutional traders sell some of their stock at higher prices. They sell some of them as the market progresses, and the that is what it is, the bull market. So this is where the demand is high for the stock. It is also known as uptrend or market phase. So then comes the distribution. So this is where the institutional traders how to make profit in the stock market. If you buy a stock, you have to sell it to someone else to make profit. So if you have to liquidate your holdings, and you have to distribute your shares to someone else to make a profit. So this is where the market is at its highest peak. So this is where the investors feel that is investors or the traders feel that the stock is overpriced, and they usually sell it at this point. So, but the retail traders, they only have a mindset to buy at this level. So what they usually does, the institutional traders transfer their shares to us. They distribute their shares to the retail traders, and they get out of the market, and they make lump sum amount of profits. Whereas we retail traders, we get their shares, and we buy at the highest point where we should not be buying, and we usually the demand becomes lesser at this point. After all the distribution occurs, usually buy and sell takes place here, and usually all the distribution occurs. There is no demand for the stock here. The buyers usually does their bidding at lower prices, though we buy at higher prices, and there is no one to buy a stock above the buying price that we have bought. So we have to sell at lower prices, and that is why we make clauses if we buy at high prices. So the supply gets higher. There are very more number of sellers, but there are no buyers. So the stock prices falls down, and usually this occurs in the case that there is what you say, the whether there is such as even during now coronavirus, the market falls so much because there is no demand. There is fear in the market. Then ultimately the market starts falling, and the institutional investors usually distribute their shares to the retail investors, and they get out of the market. And this is what is known as the bear market, downtrend or markdown phase. And when it comes down, and again the accumulation phase starts, and again the market starts. How it occurs? Because once the market falls deeply to the stock prices will be extremely cheap, but the retail traders and the normal people who know doesn't much about the stock market, they feel, and the news is the fundamental news will usually be bad. Everyone will be pessimistic about the market. Negativity will be filled around the world. They might think that people will feel like the world is going to end like that, and they will not be willing to buy. But the institutional investors and the value investors, they have greed at that point. When all others are fearing, they have the greed to buy. They buy at the lower prices. They take it as an opportunity to buy at low prices. They follow the concept of buying at low and selling at high, and they buy at low, and they create the accumulation. Again they create the same accumulation here again. and the demand for the stock is created here, and the retail traders usually only enter here or here, but the institutional traders they enter here. In case of selling, retail traders usually enter here, but the institutionals enter here. So this is what the difference between the retail normal traders and the bigger players, the institutional traders. So this is what does accumulation, uptrend, distribution, downtrend. It again occurs and occurs again and again. This is the market cycle. This is the complete trend of the market. And the next topic is trend continuation and trend reversal. So I have brought an example for bullish trend here. So I have told you the this is the starting point and this is the initial structure high. But here in this I have brought it as higher high. Of course it is a higher high, but you have to take it as an initial structure high. So ISL, initial structure high. So after this it forms a higher low, then it breaks down the high and forms a new high, and it again forms a newer low which doesn't break the previous low. So it is a trend sign of trend continuation, and it again breaks the new high and forms a new high. So formation of new highs indicates continuation of trend. Then it forms a higher low. Then the trend continues goes. When it breaks usually here. 1 minute. Um, so this is where the once it breaks the higher low, the previous low, there is a potential for the trend to reverse. This is a warning sign. Usually, this is only the potential. Then aggressive traders usually enter even after the warning. With the warning sign itself, the aggressive traders enter. But whereas conservative traders only will wait for the confirmation. Then only they will enter. Where we can confirm. Once it breaks the higher low, there is a potential for the trend to reverse. But then when there is a failure to form a new high, and then when it breaks the previous low, then the trend reversal confirmation is done. The trend is confirmed. The trend reversal is confirmed. Then after this, conservative traders and usually more number of traders enter the market. They started to sell. So how this happens is yeah, once the higher low is broken, you should consider it as a starting point. This higher high as starting point, and this has initial structure low. So this is where this concept comes. This concept, the bearish trend concept comes. This is the starting point of the bearish trend. This is where the trend converts from a bull trend to a bear trend. So you have to take it as a initial structure low, then failure to form a higher high. The market might go like this. If it goes, then it is a sign of trend continuous. Or the market might go here and come here and go like this. This is also continuous. This is a failure to form a higher high. You should consider it as a lower high. And when this low newly formed is broken, initial structure low. When this initial structure low is broken, then it forms a lower low. This is where the trend reversal is confirmed. This is what we see until asset price records a lower low. And this is the actual lower low. This is where the trend is confirmed. The bearish trend is confirmed. This is where most number of traders entered. There are two types of trade. Usually breakout trading, and breakout traders usually enter here or they enter here, whereas pullback traders enter here. Pullback traders enter here. So breakout traders enter here, pullback traders enter here. Breakout traders enter here, pullback traders enter here. So this is where breakout traders here, and this is where pullback traders enter here. What's the difference is between it's breakout trading as you should take some amount of risk, higher risk, whereas pullback trading has less risk. So your profits might be higher in case of your risk is higher. Profits might be equal, but your risk is higher in case of breakout trading. If you get losses, you might get more number of losses in a breakout. Sometimes a valid breakout is only when the candle's body gets closed. So candlesticks, I will put a new video. This is what the candle is. This is the body of the candle. And usually people trade using candlesticks or bar charts or line charts, but many of them use candlestick. This is the body and this is the wick, or you can call it a shadow. There are green candles and red candles, bull candles and bear candles. You can have any kind of colors, but usually many do it as green and red. See, once a valid breakout is confirmed only when the candle's body closes. If the wick alone closes, it may be a fake out. Fake out is known as a fake breakout. So it is not considered as a valid breakout. So this is the breakouts concepts. I'll come up in a separate video for candlesticks. So this is the what is. So this is how the trend reversal takes place in a case of bullish trend and coming to the bearish trend. So this is where the bearish trend. So a new low. So this is the starting point, initial structure low and lower high and lower low. So a breakout occurs here. The candle's body will close below this, and then lower low is formed. A new lows, as long as the new lows are formed, the trend is in continuation. The bearish trend is in continuation. Once the lower high is broken, there is a potential for the trend to reverse from the bear trend to bull trend. Potential to reverse. So you should take it as this point as starting point, and this as initial structure high, and this as higher low, and this as higher high. So here is broken, potential for the trend to reverse, then failure to form a lower low. So you should take it as a higher low. Then the initial structure high is also broken, then the higher high is projected. So this is what we saw in the lower previous slide until the asset price records a higher high. So the asset price records a higher high. So the trend is confirmed. So many traders enter here. So usually breakout traders enter here, pullback traders wait for here, and then they enter here. In case of bull market, the breakout traders enter here, the pullback traders wait for here to enter here. So I will briefly explain in back to enter and exit in some other videos. This is just a basic video. And this is what the trend continuation and reversal is. The next concept is what is the primary trend, secondary trend, and tertiary trend. Sometimes secondary trend also known as counter trends or minor trends or something. We can name different names, but you can keep it as primary, secondary, and tertiary. So primary trend. This is the primary trend. I have bought a bullish example. This is the primary trend. These are corrective trends, also known as secondary trends. Secondary trend lies within the primary trend. So this is actually this, but it might occur like as this. So this is the secondary trend. So usually we should trade along with the trend. We should follow the primary trend and trade along with the primary trend. But usually experienced traders might also trade in secondary trends, and more experienced traders such as intraday traders, scalpers, they usually even enter the tertiary trends. Tertiary trend lies within the secondary trend. So what should so this is the movements. So within the secondary trend, the tertiary trend occurs. Within the secondary trend, the tertiary trend occurs. So actual movement is this, but it occurs within the secondary trend. This is what the tertiary trend is. Once you look at the markets more often, you can easily identify what is the primary, secondary, and tertiary trend. So this is a small concept within the trend itself. So let's show you a live example in the live charts about these trend. Okay, wait. So this is one of the examples that I've bought. So you can see. So this is an example. This is the SP denotes the starting point, and ISL denotes the initial structure low. ISH denotes initial structure high. This is higher low, higher high, lower low, lower highs. So let's assume that this is the starting point of the trend. So starting point, and there comes the initial structure high, and then comes the higher low, and comes the higher high, and this is the point of breakout. This is the point of breakout. The candle's body itself is closed. Not only if wick alone closes, it might be a fake out. It might be a fake breakout, but the body itself closes. So it's a valid breakout, and then body itself is closing, and then it forms a higher high, and then it again forms a higher low, then again it forms a breakout here, and it forms a higher high, newer high, then again higher low, higher high. So this is the continuous. It denotes has the higher new highest form. It denotes the continuation of the trend. Where the trend breaks, once the higher low is broken, so the candle's body itself getting close. You see here the candles, the long candle, the body itself get closed. So you can take it as a valid breakout. So this is where the trend can reverse. There is a potential for the trend to reverse. You should take this higher high as the starting point of the bearish trend. So this higher high you can take it as a starting point of the bearish trend, and this comes the initial structure low, and then lower high is formed, lower low is formed, again lower high is formed, lower low is formed. Once the lower low is projected, then you can confirm the trend. So there are two types of entering into this trade. Once I said breakout trade. Breakout traders usually enter here. So you to see the risk and reward ratio, you can this since it is a bear market, short position means selling, long position means buying. You should take this short position in here. This is TradingView actually. I'm using TradingView.com. So so this is the once this breakouts, the traders usually enter here. The breakout traders enter here and they keep their stop loss here. The experienced traders might know what is stop loss and targets and entry points, whereas the beginners don't know. So entry is the point where we enter into a trade, and target is what we exit. We take the profits, and stop loss is we were exit at a minimum loss. So it's to protect our losses. Stop loss is used. So this is how they reward. This is the risk and this is the reward. Sometimes the risk you can keep it as less. The risk is usually high in cases of breakout trading, but whereas in pullback trading, pullback traders usually use some kind of candlesticks patterns for a pullback, or sometimes they might use support and resistance, or they might use pullbacks. So this is the swing high and swing low. This is how the Fibonacci is done. I will put a separate video for Fibonacci analysis. They usually take from 1 to 0. They usually enter here at 0.5. So the risk to reward ratio will be like this. So they will keep the risk minimum to this or to this. They might keep, and that usually the minimum risk is this, and the reward will be like this. So the risk is minimum, but the reward is higher. This is the example. This is the advantage of the pullback trading compared to the breakout trading. So this is an example of the bearish market. In case of bullish market, it's the opposite. Another example I have about is this. You see here. This is an example of a sideways market. This is the starting point, equal high, equal low, equal high, equal low. In this example, wait a minute. In this example, I have showed you the sideways trend as a flat market, but it can also be slanting. It can be like a slanting, like a channel, like a rising channel or a falling channel. It can be slanting also. The support and resistance can be in a slanting waves also. So you see, this is the starting point, equal high, equal low, equal high, equal low, equal high, equal low, equal high. And once the candle breaks, so this candle, the second candle, you can take this candle as a valid breakout. Okay, this candle, not this previous candle. You can take this candle, this bigger candle as your confirmation. And once the confirmation is done, the equal high must be taken as a starting point of bearish trend. This is the starting point of the bearish trend, and then comes the initial structure low, then comes the lower high, failure to form a higher high. If the market breaks above this point, then you can say it has a trend continuation, but it did not break. So this is a failure to form a higher high, so or a equal high. So it is you should consider it as a lower high, and then it against the breaks the initial structure low and it forms a lower low here. So usually breakout traders enter at this point, and pullback traders wait for the stock to come down. They usually use Fibonacci retracements. and wait for the stock to come above this 0.5 or 0.68 or 0.786 levels. Or sometimes they might not use Fibonacci, they might use the structure itself. They might wait for the structure to come to the initial structure low point, to the 94 rupees point, and they might take the trade. So the risk to reward will be like this. The pullback traders risk and reward will be like this. Whereas the breakout traders risk, so pullback traders usually breakout traders risk and reward will be like this. Pullback traders might use this reward itself, or they might use some yes, small rewards. Since it pull back, it might not go up further. So they might use the risk to reward ratios like this. So this is an example of the sideways market, a range bound market, where the market goes within the same range until it forms a new low or a new high. For a bullish market, it will be like this. It will be like this for a bullish market. So this is what the concept is. I forget to mention, give an example for the sideways market in my Tamil channel. So those who want to see the so if you miss that point, if you miss the example in that channel, you can watch in this channel. So this is enough for this video. This video has gone so lengthy. So in this video, you might you should have gotten a good clarification about what is market structure, the king of technical analysis. So I'll come up in upcoming videos. I will explain about candlesticks and fundamental analysis and many more videos to come, support and resistance, and many more Fibonacci retracements, trend lines. I'll bring more videos. So hope you guys enjoyed this video. I'm also conducting personal mentorship course. If you want to attend my trading classes personally, I've given my contact number in the scrolling below on my video. You can contact me and have the details. Other than that, if you want to open a Demat account, I have given a Zerodha link in my video description. In all my videos, I have given the link. So while using the PAN and Aadhaar card, you can easily open an account on Zerodha and start your initial trading or investment. And apart from that, I'll also be posting videos in my YouTube. So you can like, share, and subscribe to my channel if you're interested. And I'm taking more efforts in creating these videos, so I need your support, guys. So kindly subscribe and click the bell icon and also the all button, so you get notified for my upcoming educational videos. So until the next video, so thank you guys. Bye bye.